How to Make Money in Stocks by William J. O'Neill. Picture this. It's the early 1960s. A young stockbroker, not even 30 yet, is watching a company called Syntex, the maker of the brand new birth control pill, starting to heat up. The stock is trading at $100 a share, a price that seems absolutely insane to almost everyone watching. Wall Street analysts are shaking their heads. The big funds are dumping it. But this young broker, he sees something completely different. He spotted a pattern, like a secret code, hidden in the stock's price movements and trading volume. A code he spent years discovering by studying every major winning stock from the past 80 years. He decides to trust his system instead of the crowd's opinion. He buys in. 6 months later, the stock rockets from $100 all the way to $550. That single trade, built on years of painstaking research, made him enough money to buy his own seat on the New York Stock Exchange and launch his own firm. That young man was William J. O'Neill, and the system he created is exactly what we're diving into today. His book, How to Make Money in Stocks, has sold more than 2 million copies, not because it promises hot tips or overnight riches, but because it offers something far more valuable. A proven, timeless system for spotting tomorrow's superstar stocks before they explode. O'Neill wasn't your typical Wall Street guru. He was more like a historical detective. Instead of relying on hunches or predictions, he built one of the very first computerized stock market databases, reaching all the way back to the 1880s. Then he asked one beautifully simple question: what did all the greatest winning stocks in American history have in common right before they took off? What he uncovered was a set of 7 key traits, a pattern that kept showing up again and again, from the railroad tycoons of the 19th century to the tech giants of the 21st. He boiled it all down into one memorable acronym, CAN-SLIM. Today I'm going to walk you through that entire system. But this isn't just about memorizing an acronym. This is about learning to see the market through fresh eyes. It's about understanding that what looks terrifying to the amateur is often the golden moment for the professional. By the time we're done, you'll understand what makes every great winning stock tick, and you'll have a practical framework, a set of clear rules that can shield you from devastating losses while positioning you for extraordinary gains. This is the blueprint that turned William J. O'Neill into a legend, and it's a blueprint that anyone with focus and discipline can learn to follow. Let's kick things off with a truth that flips conventional wisdom completely upside down. Most people believe the secret to investing is to, quote, buy low and sell high. Makes perfect sense, right? Find a beaten-down stock that looks dirt cheap, buy it, and wait for it to bounce back. But here's what William J. O'Neill discovered after digging through a century of market data. That exact strategy is why most people lose money. He called it the great paradox of the stock market. What seems dangerously high and risky to most people usually keeps climbing higher, while what looks cheap and safe usually keeps sinking lower. Think about it this way. For a stock to climb from $50 to $100, it has to pass through 51, then 52, then 53, hitting new price highs the entire way up. The greatest stocks in history didn't launch their incredible runs from the bargain basement. They launched by breaking into new high territory, showing undeniable strength that most people were too scared to touch. This is the first mental shift you need to make. Stop hunting for what's cheap and start hunting for what's exceptional. The best companies, with the best products and the strongest earnings, will command premium prices, just like the best art or the best real estate. Your job isn't to find a fixer-upper. It's to find the gleaming new skyscraper, just as construction finishes, right before everyone else realizes how spectacular it is. So how do you find these skyscrapers? That's where O'Neill's CAN-SLIM system enters the picture. It's not just a checklist, it's a story. It's the complete biography of a great stock, and each letter represents a crucial chapter. The first 2 letters, C and A, are the beating heart of the story. They stand for current quarterly earnings and annual earnings growth. This is the company's engine. O'Neill discovered that 3 out of every 4 of the greatest stocks in history showed massive earnings increases in the quarters, right before their prices exploded. We're not talking about modest 5 or 10% gains. The average was over 70%. Some were up 200, 500, or even 1,000%. Think of it like this. A company's earnings report is its report card. Would you rather invest in a student bringing home C's and D's, or one who suddenly starts bringing home straight A's? The market is essentially a grading machine, and it rewards spectacular performance. For the C, you're looking at the most recent quarterly earnings per share compared to the same quarter last year. Is it up by at least 25%? The higher, the better. And just as important, is that growth accelerating? If a company was growing at 20%, and now it's growing at 50%, something major is happening. The rocket engines are firing. But one incredible quarter could be a fluke. That's why the A for annual earnings is so crucial. You want to see strong, consistent earnings growth over the past 3 to 5 years. This proves the company isn't a one-hit wonder. It has a track record of sustained excellence. O'Neill looked for companies growing their annual earnings by at least 25% or more, year after year. He also examined something called return on equity, or ROE. Don't let the technical term throw you off. It's simply measuring how effectively a company's management turns investors' money into profits. The best companies had an ROE of 17% or higher, with the truly elite hitting 25 to 50%. This signals supremely efficient, well-managed companies. When you combine a massive recent earnings jump, the C, with a strong history of annual growth, the A, you found a company with a powerful engine. You found a company that isn't just doing well, it's doing better than it ever has. But even the strongest engine needs a spark to ignite it. That spark is the N in CAN SLIM, and it stands for new. New products, new management, or a new high in price. O'Neill found that over 95% of the greatest stock market winners were connected to something new. It might be a revolutionary product that transforms an entire industry, like Apple's iPod back in 2004. Before the iPod, Apple was just a computer company. After, it became a cultural phenomenon. Its stock formed a perfect cup-with-handle base. More on that in just a moment. And then exploded, climbing over 1,500% in the following years. It could be new leadership that shakes up a sleepy company, or new conditions reshaping an entire industry. But the most important new is a new high in price. This brings us right back to that great paradox. O'Neill's research showed that the optimal moment to buy a stock is precisely when it's breaking out of a consolidation period and hitting a fresh price high. Now, this is where the art and science of reading charts comes into play. And I know what you might be thinking. Charts? Aren't those just a bunch of random, squiggly lines? O'Neill had a brilliant way to explain this. He said, an investor who refuses to use charts is like a doctor who refuses to use X-rays or MRIs. The chart is a picture of what's happening inside the stock. It's a factual record of supply and demand, of human psychology playing out in real time. It reveals the health of the stock. After a stock has enjoyed a solid run-up, it naturally needs to take a breather. It pulls back and moves sideways for a while. This period is called a base, or a price consolidation. It's a healthy, necessary process where the stock shakes out nervous, short-term holders and builds a solid foundation for its next big move. O'Neill discovered that these bases form recognizable patterns that repeat themselves over and over, decade after decade. The most common and reliable pattern looks just like a teacup when you view it from the side. He called it the cup-with-handle pattern. Imagine a stock has been climbing steadily. It hits a peak, then starts pulling back, drifting downward, and forming a nice rounded bottom, the U-shape of the cup. This correction might be anywhere from 12 to 33%. After hitting bottom, the stock climbs back up the right side of the cup, stopping just short of its old peak. Then something crucial happens. It drifts down and sideways for a week or two, forming a small, gentle pullback. This is the handle. The handle is the final shakeout, the last chance for weak hands to bail out before the real move begins. It should be a minor correction, usually no more than 8 to 12%. During this time, The trading volume, the number of shares changing hands, should dry up significantly. This is a telltale sign that selling pressure has been exhausted. There's barely any stock left for sale. The perfect buy point, what O'Neill called the pivot point, is when the stock breaks out of this handle and pushes to a new high on a massive surge in volume, at least 50% above its normal daily average. That big volume spike is your signal. It's the thunderous sound of major institutional investors, the mutual funds, the pension funds, pouring into the stock, confirming that the smart money believes this stock is ready to launch. This pattern showed up in countless winners. It appeared in Texas Instruments back in 1958, right before it soared from $25 to $250. It was there in Xerox in 1963, before its spectacular climb. It was there in Apple in 2004 and Google later that same year. History doesn't just rhyme in the stock market. It often repeats itself almost note for note. Learning to spot these patterns is a genuine skill. It takes practice. But it's a skill that can give you a tremendous edge, helping you time your entry with precision, right at the moment of least resistance. So now we have a company with a powerful engine, C and A fresh catalyst, N, and we've identified the perfect launch pad from its chart pattern. What's next? We need to look at S and L. S stands for supply and demand. The price of anything, whether it's a tomato or a share of stock, is determined by supply and demand. O'Neill noticed that many of the greatest winners were companies with a reasonable number of shares available to the public. If a company has billions upon billions of shares floating around, it takes enormous buying pressure to move the price. It's like trying to turn an aircraft carrier. But a company with fewer shares is more like a speedboat. It can accelerate much faster. He also looked for companies where top management owned a significant chunk of stock. When the people running the show have their own money on the line, their interests align perfectly with yours. It's a powerful vote of confidence. Another positive sign is when a company buys back its own stock in the open market. This reduces the available supply of shares, which can help drive the price higher. It's also a signal that management believes their stock is undervalued. But the most important measure of supply and demand is trading volume. As we discussed with the cup with handle pattern, you want to see massive volume on the breakout. That's the sign of serious demand. On the flip side, you want to see volume evaporate during pullbacks. That shows a lack of selling pressure. The chart tells you this entire story. L stands for leader or laggard. This is simple but profound. In any industry there are leaders and there are laggards. You always want to buy the leader. But how do you define the leader? It's not necessarily the biggest company or the one with the most famous brand. The true leader is the one with the best earnings growth, the highest profit margins, the strongest sales, and the most powerful stock price performance. It's the company gaining market share and innovating while its competitors scramble to keep up. O'Neill developed a simple tool to measure this, the Relative Price Strength Rating, or RS rating. It's a number from 1 to 99 that shows how a stock's price performance over the past year compares to every other stock. A stock with an RS rating of 90 has outperformed 90% of all other stocks. The average RS rating of the greatest winning stocks before their big moves was 87. They were already outperforming nearly 9 out of 10 other stocks before they even started their most explosive runs. This is another paradox. Most people gravitate toward the laggards, the beaten-down stocks in a hot industry. They think, well, Syntex looks expensive, but this other company, Searle, has a similar product and its stock is way cheaper. This is called a sympathy play, and it rarely works out. The leader gets the feast, the runner-up gets the scraps. Your job is to buy the best of the best, the true leaders, even if they seem pricey. So now we've got a leading company, L with strong demand, S, a fresh catalyst, N, and a powerful earnings engine, C and A, just 2 more pieces to complete the puzzle. The I in CanSlim stands for institutional sponsorship. This is one of the most important, yet least understood factors. It takes massive demand to move a stock price significantly higher. The biggest source of that demand comes from institutional investors. Mutual funds, pension funds, hedge funds, banks, and insurance companies. They're the elephants in the market. When they start buying a stock, their immense purchasing power can drive the price upward for months or even years. You want to buy stocks that have at least a few institutional owners. A complete absence of institutional ownership means thousands of professional analysts have examined the stock and passed. That's not a good sign. But you don't just want any institutions, you want the best ones, the ones with the strongest recent track records. If a top-performing mutual fund has recently taken a position in a stock you're watching, that's a huge vote of confidence. They've done their homework, and they're putting serious money behind their conviction. However, there's a flip side. A stock can become too popular. If a company's success becomes so obvious that hundreds or thousands of institutions own it, it becomes overowned. At that point, the stock is vulnerable. If something goes wrong, or a bear market begins, all those institutions will rush for the exit simultaneously, creating massive selling pressure. The sweet spot is finding a stock with a growing number of high-quality institutional owners, but before it becomes too widely known and over-owned. You want to board the train as it's leaving the station, not after it's already reached its destination and is packed to capacity. This brings us to the final and perhaps most critical letter in the CAN-SLIM system, M, for market direction. You can be absolutely right about every single one of the other 6 factors. You can find the perfect company with explosive earnings, a groundbreaking new product, a flawless chart pattern, and backing from the best funds on Wall Street. But if you buy it at the start of a bear market, you will lose money. O'Neill was absolutely adamant about this. He stated that 3 out of every 4 stocks will move in the same direction as the overall market. Fighting the market trend is like swimming against a riptide. It's exhausting and ultimately futile. So how do you determine the market's direction? You don't listen to talking heads on television. You don't read economists' forecasts. You do exactly what O'Neill did. You watch the market itself. You follow the major market indexes, the S&P 500, the NASDAQ Composite, and the Dow Jones Industrial Average every single day. You interpret their daily price and volume action just like you would for an individual stock. A market top doesn't happen overnight. It drops clues. The most important clue is what O'Neill called a distribution day. This is when a major market index closes down or stalls with minimal progress on heavier volume than the previous day. It's a sign that big institutional investors are quietly unloading their holdings, distributing shares to unsuspecting buyers while the market still hovers near its highs. One distribution day isn't a problem, but when you see 4 or 5 of these days cluster together over 4 or 5 weeks, it's a major warning signal. The market is showing internal weakness. The tide is turning. This is your cue to start selling your stocks, locking in profits, and building up cash. This isn't about calling the exact top to the day. It's about recognizing the warning signs and acting defensively to protect your hard-earned gains. Thousands of O'Neill's readers did precisely this in March 2000, and again in late 2007, selling their positions and moving to cash before the devastating bear markets that followed. They were prepared because they knew how to read the market's message. Just as a market top gives warnings, so does a market bottom. A new bull market doesn't just suddenly appear. After a period of decline, the market will attempt to rally. The first few days are tentative, but then, usually on the 4th to 7th day of the rally attempt, you'll see what O'Neill called a follow-through day. This is when a major index surges upward, say 1.5% or more, on a big spike in volume. This is the market's green light. It's confirmation that the new uptrend is genuine and backed by institutional power. It doesn't mean you should rush out and buy everything in sight. It means it's now safe to start buying those leading stocks as they break out of sound bases. Learning to read the market's direction is the skill that separates successful investors from everyone else. It's the single most important element in the entire system. So there you have it, the CAN-SLIM system. It's a complete approach. You need the strong fundamentals of C and A. You need the catalyst of N. You need the timing provided by chart patterns, S and L. You need the confirmation of I. And above all, you need to be in sync with M, the overall market trend. But buying is only half the equation. O'Neill learned early in his career that knowing when to buy was useless if he didn't know when to sell. This led him to develop strict, non-negotiable sell rules. Most important rule, the absolute cornerstone of his defensive strategy, is this: always, without exception, cut every loss at 7 or 8% below your purchase price. This isn't a suggestion, it's an ironclad rule. If you buy a stock at $50 and it drops to $46, you sell immediately, no questions asked, no hoping it'll bounce back. You admit you made a mistake, take the small loss, and move on, preserving your capital for the next opportunity. Why is this so critical? Because every 50% loss starts as a small loss. Letting losses run is the single most destructive mistake an investor can make. A 33% loss requires a 50% gain just to break even. A 50% loss requires doubling your money. 100% gain just to get back to square one. The math becomes your worst enemy. Taking a small loss is like paying an insurance premium. You're protecting yourself against catastrophe. Yes, sometimes you'll sell a stock and it'll turn around and rally. It's frustrating. But you don't buy fire insurance because you know your house will burn down. You buy it in case it burns down. The 8% sell rule is your investment fire insurance. Now, what about taking profits? This is where most people get it completely backwards. They're quick to grab small profits but slow to cut large losses. They'll sell a stock after a 20% gain because they're terrified of losing it, but they'll hold a stock that's down 20%, desperately hoping it'll recover. O'Neill's rule was to flip this on its head. Take your losses quickly and your profits slowly. His general guideline was to aim for a 20 to 25% profit on winning stocks. If you can capture 25% on your winners and cut all your losses at 8%, you can be right only one time out of 3 and still make money. But he had one crucial exception. If a stock is so powerful that it jumps 20% in just 1 to 3 weeks after breaking out, you don't sell. This is a potential super stock, one of those rare leaders that could go on to gain 100, 200% or more. In this case, you hold on for at least 8 weeks, giving it room to run and sitting through its first normal pullback. O'Neill also identified specific sell signals that warn a stock is topping out. These are often signs of what he called climax action, where a stock has one final explosive burst before running out of steam. For example, after a long advance, if a stock has its single largest one-day price gain on its heaviest volume ever, it's often a sign the move is ending. Another warning is an exhaustion gap, where a stock gaps upward in the morning after a long run. These are signs of euphoria, and euphoria almost always signals the top is near. By having a crystal clear profit and loss plan, selling losers at 8% and taking profits at 20 to 25% unless it's showing superstock strength, you remove emotion from the equation. You have a system. You're no longer hoping or guessing. You're operating like a professional. Ultimately, the lessons from how to make money in stocks go deeper than just a clever acronym. They're about discipline, about doing your homework, and about respecting the market. They're about understanding that success in investing doesn't come from being right all the time. It comes from having a system that ensures your winners are bigger than your losers. It's a journey of continuous learning, of studying your mistakes, and of building the mental toughness to follow your rules, even when it's uncomfortable. It's a method that has stood the test of time because it's based not on opinions or predictions, but on the unchanging realities of how markets and human nature truly work. As we wrap up our journey through William J. O'Neill's masterpiece, I want to step back for a moment and reflect on what makes these ideas so powerful and enduring. When you strip everything away, this book isn't just about buying and selling stocks. It's about a way of thinking. It's a manual for making smart decisions when the future is uncertain, and its lessons reach far beyond the world of finance. The first profound lesson is the power of objective historical evidence over personal opinion and emotion. In a world drowning in noise, expert predictions, hot tips, breathless media coverage, O'Neill's message cuts through like a laser. Trust the facts. He didn't ask what people thought the market would do. He asked what the market actually did. He built his system on recurring patterns of success, not gut feelings or compelling stories. This is a lesson for life itself. How often do we make decisions based on what we hope will happen, or what others insist should happen, instead of examining the cold, hard evidence? O'Neill teaches us to be detectives, not fortune-tellers. To observe, to measure, and to act based on proven precedent. The second powerful idea is the absolute necessity of rules, especially sell rules. The single most important rule in the entire book is to cut every loss at 7 or 8%. This isn't just a financial tactic. It's a profound exercise in psychological discipline. It's about conquering your ego. It's about admitting you were wrong quickly and decisively, before a small mistake snowballs into a catastrophic failure. Think about how this applies elsewhere in life, in our careers, our projects, even our relationships. How often do we cling to a failing venture, throwing good resources after bad, simply because we can't bear to admit we were wrong? O'Neill's rule forces us to face reality head-on. It teaches us that true strength isn't about never making mistakes. It's about having the discipline to correct them immediately, preserving our resources, whether financial, emotional, or intellectual, for the next, better opportunity. And finally, there's an inspiring thread of American entrepreneurship woven throughout the entire book. Those 100 charts of the greatest stock market winners aren't just lines on paper. They're portraits of innovation. They tell the story of America itself, from the railroads that stitched the nation together, to the automobiles that put it on wheels, to the computers and software that connected it to the world. Each chart represents a bold new idea, a breakthrough technology, a revolutionary way of living, brought to life by relentless innovators. O'Neill shows us that investing isn't merely a passive activity. It's a way to participate in this incredible story of growth and human ingenuity. By learning to identify these leading companies, you're not just buying a stock ticker symbol. You're investing in the very engine of progress itself. So what can you do starting today? Here are 3 simple actions to begin putting these principles to work in your own life. First, become a student of the market. You don't need to dedicate hours every day, but commit to just 15 minutes. Read the Big Picture column in Investor's Business Daily. Look at the charts of the major indexes. Simply observe. Get a feel for the market's rhythm, for its moments of strength and weakness. Second, pick 2 or 3 companies you genuinely admire. Maybe it's a company whose products you love, or whose mission inspires you. Start tracking them. Look up their quarterly earnings reports. Find their stock charts. Try to identify the patterns we've discussed today. You don't have to invest a single dollar yet. Just practice the art of analysis. Third, and most importantly, internalize that sell rule. Whether you're investing real money or just practicing on paper, make a pact with yourself right now. If a position drops 8% below your entry point, you sell. No exceptions, no excuses. This is the single most important habit you can build. It's your shield, your safety net, and the foundation upon which all future success will rest. That was a summary of How to Make Money in Stocks by William J. O'Neill. We've covered the major themes today, but I'll be honest with you, a summary can only ever be a map. The real treasure is found when you make the journey yourself. The true magic happens when you're reading the book, and a particular story or a simple phrase connects with you in a way you never expected. This summary is designed to help you decide if this book deserves a place on your shelf and in your life. If anything we've talked about today has resonated with you, I genuinely encourage you to grab a copy. Reading it isn't just about absorbing information. It's an experience that can fundamentally change the way you see yourself, your money, and the world of opportunity all around you. The link to the book is in the description below. Also, if you found this journey valuable, please take a moment to like this summary and subscribe to the channel. That way, you won't miss our next exploration into another life-changing book from the billionaire's bookshelf. Let's keep growing and learning together.